Hello, this is Chen. Welcome to my channel. Today we gonna study IAS 38, Intangible Assets. So this is a high frequency CTA topic, and it is often examined together with IFRS 3 and IAS 36. In this section, we will systematically cover recognition, internal generated intangible assets, subsequent measurements, and finally, derecognition. So let's go to part 1, recognition and the initial measurements. So IAS 38 defines the intangible assets as a identifiable non-monetary assets without physical substance. This definition must be memorized precisely because exam question always test each element of this definition. Let's check the key characteristic. First one, identifiable. So these assets can be separated from the entity and sold or transferred, or it is a license, or arise from contractual or legal rights. What is non-monetary mean? It means not fixed in currency terms. What is mean no physical substance, which means you cannot touch it. And what is the control by the entity? Which means it must be provides the future economic benefits. A critical point here is goodwill. Many students ask about it. Just remember that the internal generated goodwill is never recognized. And if you purchase goodwill from our business combination, it's covered by the IFRS 3, not IAS 38. Mainly because it failed identifiable definition and has different accounting rules. So what is identifiability? An intangible asset is identifiable if it must satisfy at least one of these two criteria: separability or arising from contractual or legal rights. If neither condition is met, item cannot be recognized as an intangible asset. This concept of identifiability is vital, especially when we link it to IFRS 3, business combination. Here's a classic example scenario. So company A buy company B, and B has an internal generated customer list. On B's own books, it is not an asset, but on the acquisition day, Company A must assess if this list meets the identifiable definition. If it does, Company A must recognize it separately at fair value, and this affects the goodwill calculation. It's a common exam trick to test your understanding of both standards. To make this clear, the example of intangible assets including your patents, your trademarks, your copyrights, and license. In exam, always assess whether this item meets the identifiability criteria. So, how do you initial measure the intangible assets? Initial measurement under IAS 38 follows the logic similar to IAS 16. Intangible assets are initial measure at cost, which including your purchase cost, non-refundable tax, and all expenditure directly attributable to bring the assets to its intended use. The exam focus here is often on what not to include. The examiner will often include irrelevant cost to mislead you. Advertising, staff training, and other indirect costs must be expensed. not capitalize it. Costs incurred after asset is ready for use are also excluded. The journal entry for initial recognition is straightforward. You debit the intangible assets in statement of financial position and credit back. Now let's move to part 2, the internal generate intangible assets. The internal generated intangible assets, which are heavily exempt at CTA level. IAS 38 spells the process into a research phase and a development phase. All expenditure incurred during the research phase must be expensed to profit or lost. There's no exception. Here at this case, development costs must be passed to be capitalized. All must be satisfied. What are they? They are technical feasibility, intention to complete and use or sell, ability to use or sell, probable future economic benefits, adequate resource, and the last one, reliable measurement of cost. In exam, they often provide the hints like the management has approved the project and they intend to launch it, which points to criteria 2 and 5. Like pattern has been granted, which satisfies criteria 1. Therefore, you need to read the scenario very carefully. A practical application is website development. Under SIC 32, a website may qualify as an intangible asset. The underlying logic is identical to IAS 38. Only the wording is different. Let's highlight some exam traps and practical example. First one, if you cannot separate research from development, all cost expense. Second, you're selling your administration cost, like or your training or inefficient cost or your initial operating loss are excluded from capitalization. Third, you cannot go back and capitalize something you have already expensed. What is the inefficient and the initial operation lost? Let me give you an example. So like you buy mining rights. You pay the local prospector who fail is inefficiently expensive. And if you hire a professional team whose work leads to discover is the directly attributable cost. Capitalizes. This distinction is key. Now let's move to part 3, subsequent measurements. After initial recognition, what's next? We must consider its useful life. If finite, we amortize it, just like the depreciation in PPE. The general entry is we debt amortization expense in profit and loss, and we criticize accumulates amortization in statement of financial position. If the life is infinite, there's no amortization, but we must perform an annual impairment test without fail. So impairment is critical link to IAS 36. An asset is impaired if its carry amount on the balance sheet excludes what we can recover from it. Remember this special case. Assets with indefinite lives, assets still being developed, or you purchase goodwill. This requires a compulsory annual payment check, even if nothing seems wrong. Now let's move to the last part, the recognition. You sell or retire an intangible asset. You remove it from the books. You write off its full carrying amount. The difference between the disposal process and this carrying amount is a gain or loss, which hits the profit or loss statement. It's conceptually identical to disposing of the piece of PPE. Thank you for watching and I hope this section was helpful.